In yesterday's post, I had this to say: banks will continue to fail every day unless this emergency plan is enacted in the next day or two. Okay, so today we saw Wachovia be swallowed by Citi. Citigroup was down almost 12%. Citi paid $2.2 billion in stock to acquire nearly $100 billion in assets plus their liabilities. The deal was facilitated by the FDIC, and the FDIC had seized Wachovia last week, same as they did with Washington Mutual. So Citi, in an effort to help pay for this, will raise $10 billion in common stock offering, and you can see the result of that, because as they put more stock on the market, they dilute the value of the shares that are already out there. So you can see we had almost a 12% drop, and part of that is going to be attributed obviously to the dilution of adding more shares. They're also slashing their dividend in half. Citi is now the largest U.S. bank. They have total assets now of $2.91 trillion. So this pretty much the FDIC selling Wachovia to Citi is more or less a vote of confidence from the FDIC in Citigroup. Also, we had 3 European banks that had to be bailed out today by 3 different governments, and actually 4 banks in the last 2 days in Europe. So like I said, every day this goes on, we're going to see more and more banks, whether it be the big ones like Wachovia and Washington Mutual, or it be the smaller regional banks. In this morning's contributor letter, I mentioned that the markets dislike those additional conditions that I mentioned earlier, and I said watch to see if important support levels are taken out, and we'll know if the market is just posturing or if this dislike is, really deep and true. So if we take a look real quick at the Dow Jones 30, and we'll look at a 30-minute chart, you can see this support level here around 10,800 was just absolutely sliced through. You can see that support level just absolutely decimated. So the market is pretty darn serious about this. But this is actually something that occurred after the vote. We had a little bit of initial support here where this bear flag formed, and I had talked about that bear flag as well. We'll get to that. At 11:30, I put out another market letter. I think I had 5 contributor letters today that went out, and I noted that these major indices like the Qs and the Dow, the S&P, XLF were forming these bear flags. Again, the bear flag, here's your flagpole, here's your flag. It looks like an upside down flag, and this is a consolidation pattern that resolves in the direction of the preceding trend. Preceding trend is down, so when we get a breakdown out of that flag, we expect to see a move down. Generally, the move is roughly equivalent to the size of the flagpole over here. So if we take a look at the Qs real quick, I mentioned by looking at this bear flag and extrapolating the numbers and everything that we would see a target sometime today. I expected of $37. So we got down to about $37.15 or so. So I'm off by about 15 cents, but I think that was a pretty good call considering it was up there around 39.25 or so. And now I'm going to pull up the Spiders, which is the ETF for the S&P 500, and we're going to take a look at a 5-minute chart. And here is today. You can see our original sell-off, and then we got that little bit of a flag formation that formed in here, and then we got another sell-off. This sell-off was after the vote failed, the Emergency Stabilization Act of 2008. So when that failed by 11 votes, the S&P dropped from this point 8.8%. I mean, a huge, huge drop for a big index like that. The vote broke down on the party lines with the Democrats 141 for, 94 against. The Republicans had 66 for, 132 against. I think they needed something like 188 in votes. Anyway, in any case, they missed by 11 votes. Tragically, I think, I'm not blaming entirely, but I think it was a big mistake for the House Speaker, Nancy Pelosi, who gave a very aggressive partisan speech just minutes before the vote, a lot of the Republicans are saying that they lost at least 12 votes who were teetering, and you gotta understand the Republicans were not comfortable with this plan, despite the fact it was put out by President Bush. So a lot of these Republicans were already teetering, and supposedly at least a dozen of them changed their vote after that speech. Now, I agree with Barney Frank. If your feelings are going to hurt and you're going to change your vote, in a matter like this, you shouldn't be in Congress. I agree with that 100%. But I'd also say that Mrs. Pelosi or Miss Pelosi could have waited until after the vote was given. This was billed as a bipartisan effort, and to make that kind of a speech just minutes before the vote, I think was a very foolish thing to do, and I think that she's going to catch some of the blame. So the S&P 500 ended the day down 7.84%. This is the worst decline since October of 1987. This leaves the S&P at 12.6% decline month to date, which is the worst since the September 11 attacks. Gold, let's pull up a ticker for gold real quick. We'll use GLD. But gold was up over 3% today. When the market gets uneasy, you see a flight to safety, and usually that flight to safety is a flight to gold. So gold was one of the few things that was up today. So over 3% in gold. The S&P is also down year to date, and that is the worst year to date since September 11th. Let's take a look at the Dow Jones 30, and we're going to look at a 5-minute chart. Okay, at the session lows today for the Dow, it was down over 7%, and it closed actually it looks like it closed down its lows today. The Qs, and again a 5-minute chart, at the session lows on the Qs, they were down 9%, or the NASDAQ composite 9.1%. The S&P 500, I'm going to use the spiders here, was down 8.8%. So the NASDAQ and the S&P had the worst declines that they've seen since Black Monday 1987. The Dow saw the worst decline it's seen since September 11th. Taken as a whole, for the market as a whole, this was the worst decline that's been seen in 21 years. So that's why I say, if you were paying attention today, you saw something historic. Let's take a look real quick at the VIX. And the VIX is the Chicago Board of Options Market Volatility Index. And basically the VIX has an inverse relationship with the market. And what it signals is, when we get spikes like this signals extreme fear and unease about the market and what's going to happen over the next month or two. And when we see extreme lows, like over here, it signals complacency. And if I pull up a comparison symbol, and we'll use the S&P 500, you'll see the inverse relationship. If I grab a marker here, you see when we get spikes in the VIX, that tends to be the bottom of a decline and we see a rally. And when we see lows in the VIX, that tends to be a top in the market and we see a sell-off. So again, this spike could very well be the prelude. This spike could be the prelude to a rally. Let me zoom out a little bit so you can get a better understanding. You can see just how dramatic this inverse relationship is. Again, a spike, and S&P is in red here, and we get that rally. Over here, a dip, and we get the sell-off. So the VIX is a pretty good gauge of investor and trader sentiment. In any case, if I pull up a 5-day chart, you can see that the levels that we reached today, looks like nearly 47, were the highest that we've seen since 2002. So to give you an idea, the bear market, or the bull market actually, started around 2003, where we would have seen levels that were similar to today. So a huge spike in the VIX, probably signaling a rally to come soon, and that's what we're also seeing in my 3C indicator.